Hi, I'm Steve Chater with TCT Property Management Services, and thank you for taking a few minutes to meet with us today. I expect our conversation today will help you better understand the value of the real estate investment that you've entrusted to us. Janice and I are the owners of TCT Property Services, and we're also co-authors and contributors to two national best-selling books on real estate investing. At TCT, we're more than just property management. We support people building financial security with real estate. If you've not read our book, Hold, please call. We'll make sure that you get a copy. For the next couple of minutes, we're going to talk about the reality of the Phoenix real estate market. Everybody knows the news media gravitates to the negative and sensational headlines, and we want you, our clients, and our friends to profit from the truth. Inflation. Inflation is here. It seems to be getting worse, and it's not going away anytime soon. So as you know, the Fed is trying to stop the inflation by raising the interest rates. And the higher rates are having an effect on our market. Buyers are having a harder time qualifying to buy a home. New home builders are even putting the brakes on for developing new single family home subdivisions. That's bad news for some home buyers and good news for investors like you and me. People have to live somewhere, and we have the houses that they want. So let's talk a minute about appreciation. When you invest in the stock market or real estate or any investment, the goal is to have the value of your investment go up. Real estate typically increases in value over time. In fact, when Janice and I did the research for our book Hold, we looked back many decades, and the average appreciation of real estate across the country was 4% per year, much better than the inflation rate. The long-term average for the Phoenix area is 4.5% a year, higher than the national average. The other thing that investors know is that the rents typically go up with inflation. In fact, our experience for the past more than 40 years has been that the rents follow the interest rates. And when rates go up, the rents go up too. So let's take a look at appreciation. This chart shows what's happened to your investment since 2019. Look at the green line. 2019 shows that property values went up about 9% that year. Then when you get to 2020, property values are up over 17%. 2021 property values, this is Phoenix area property values, are up almost 27%. And in 2022, so far, the average appreciation based on price per square foot has gone up 21%. So you can also see when you look at the line for 2022 that the increased interest rates are having an effect. It's flattened out and it's probably coming down a bit. Now, what's coming down is the rate of appreciation, not the fact that properties are going down in value. They're just not going up as fast. So what does this mean to you as an investor? Well, imagine you bought your property in 2019 and you paid $30,000 or $300,000 for it. The value of that property has increased much faster than the 4.5% average. Based on the average price per square foot, your equity likely grew by $230,000 in just 3.5 years. That's like a savings account that's growing at almost $5,500 per month. Let's take a look at a longer term. The price of the average home in the year 2000 was $172,000. If prices only kept up with inflation, that same house would be almost $300,000 today. However, anyone who held on to that Phoenix area investment property now has an asset worth $533,000. That's almost $250,000 more than the rate of inflation. Add the increased rental income and the tax deductions, you can see why we titled our book Hold. The people who did not understand what I'm presenting today sold their rental property in the past few years, and I believe they made a huge mistake. The best news for the rest of us is this trend is not stopping. And here's why. Our mission is to help investors and their families build financial security for themselves and with real estate. So the big picture here, the big picture for Phoenix area investors is the market is shifting, but it's not stopping. Let me share this with you. According to Roofstock, published just a couple of weeks ago on June 14th, real estate investors are purchasing more homes in the Phoenix area than any of the other top 30 markets in the US. That means you already own what they're trying to buy. Why is this happening? Hey, people are cashing out of the stock market and they're buying rental properties. Why Phoenix? People are moving here and jobs are moving here as well. I'm going to quote a New York Times article that said, quote, Arizona's desert capital grew at the fastest rate among America's biggest cities, vaulting it ahead of Philadelphia to officially become the 5th biggest city in the United States since the last census. The increase has been fueled not just by immigration and sun-seeking retirees, but also by the arrival of tech companies and middle-class families from California and other more expensive parts of the country seeking more affordable housing. Look at the population growth for just the past couple of years. You can see that we've had a new mid-sized city moving here in just 2 years, and it hasn't stopped. So what's happened? Well, we've added apartment units here by the thousands. Phoenix, however, has not built enough single-family homes for the population growth for more than 15 years. It's going to take many years to catch up to the pent-up demand for these houses. But as I said, people are still moving here, and Arizona is one of the fastest growing states. That's why people are still investing here. Look, it's no secret that the stock market is not having a good year. But while the stock market has gone down, the real estate market has gone up. The average sales price in January of this year was $540,000. It has gone up $50,000 since January and $85,000 since the same time last year. As I said, the Federal Reserve is raising interest rates in order to slow down the sales and the price increases. The higher rates means people who wanted to buy and now can't qualify now make excellent renters. As property owners, we are in the right spot at the right time. As I said, money is coming out of stocks and bonds and buying rental homes. Why? All the reasons we just talked about. The rents are a hedge against inflation. The low number of houses built for the past 15 years. The population is growing. Industry is moving here from other states. All this means that prices are not coming down. Imagine you own an asset and a complete stranger, somebody you don't even know, pays you to use it. Now, imagine they'll pay you enough to make the mortgage payments plus all of the other expenses. Now, let's just pretend that the property never goes up in value. That hasn't happened, but let's just pretend that the value stays the same as what you paid for it, but the tenants paid off your loan. Did you know that that asset, that investment nets you a larger return on investment than the historic returns in the stock market? Our values are going up. But even if they weren't, your real estate is a great investment. Think about this. If you have a positive cash flow and you use the tenant's money to make extra principal payments each month, your mortgage is eliminated many years sooner. And now the rental cash flow is there for you to fund your life. In fact, if you haven't watched it yet, our YouTube channel, go to our YouTube channel and make sure that you take a couple of minutes to watch our video on the single family home retirement strategy. You will see how to make a 20 to 30 year retirement goal happen in 10 to 15 years. And with today's rents, it could happen even sooner. All right, let's go back to the market. The median rents in Phoenix have gone up $700 per month since 2019. Look, if you're wondering about your property, please call us anytime. We're going to make sure that you get full market rents. Our market is shifting a little, and it normally does in June. Rent increases have flattened out. This is partly because of the new single-family home subdivisions that are for rent only. They're finishing construction, and they're now available to rent. These homes are typically smaller with no private yards. However, the communities have amenities like pools and recreation facilities. So we're watching this carefully so that we can advise you on the right amount to charge for your investment property to maximize your return on investment. Let's kind of wind it up this way. Many of the uninformed people will say that we're in a bubble and it's going to pop. It's not popping. Don't listen to the uninformed. We're here to help you profit from the truth. At TCT, we're more than just property management. I've said it before. We help investors and their families build financial security with real estate. So I want to kind of wrap this all up and end with a quick video by the famous money guy, Dave Ramsey. And after this 2-minute video, we can open it up for questions.
All right, let's talk real estate. A lot of folks are saying, I'm going to sit on the sidelines and wait on buying because house prices are going to go down. Let me help you with this. House prices are caused by one thing and one thing only: supply versus demand. How many houses are for sale versus how many buyers there are. Buyers are fewer in a bad economy, a high interest rate economy. There's fewer buyers, but they have to be less buyers than supply for house prices to go down. That's not going to happen. Here's the real numbers. Here's data, not feelings. Let's talk this through. 5 million more 35-year-olds right now in the millennial generation, prime house buying age, than there were in 2007. 128 million households right now. In 2007, only 116 million households. 12 million more households operating that need a house. And yet there's a shortage of housing. In 2007, we had 2.1 million new housing starts. This year, we'll have 1.4 million new housing starts. We have 50% as many houses for sale right now as we had in 2007. Inventory is at half. So the number of buyers would have to go down so dramatically before the house market prices go down. It's not going to happen, guys. House prices went up 32% in 2020, 18% in 2021, 7% this year in 2022. Next year, projected to be a 5% increase. Every year for the next 5 years, we're going to have fewer houses for sale than buyers wanting to buy them, driving the price up. House prices are going to go up every year for the next 5 years. If you're ready to buy, you're in good shape financially, you need to buy now. Don't wait on house prices to go down. They're not going down. What goes up must go down. No, it doesn't. I just gave you data, real facts. They're not coming down.
So thank you for spending the time. You know, I just had a thought. If you have equity in your home, it might make sense for you to use that equity to purchase another investment property. They're continuing to go up in value and the tenant pays it off for you. Even though the rates are higher, so are the rents. Even though the prices are higher, so are the rents. So call your agent. It's a good time to buy. If you need an agent, call us. We don't sell houses, but we know some great agents that do. So thank you for taking the time. Thank you for being a part of TCT. We appreciate you. Our goal is to be the resource for people building financial security with real estate.